Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliet Sarli. Great to have your company. It's been a big day. Let's have a look at where the local market is tracking. Pretty flat there on the CBO 200, but the S&P ASX 200 tells a different picture today. We are seeing it lower by 1/3% or 29 points to 8,755, trying to rally here into the close. But of course, there has been renewed Gulf hostilities, which is really playing on overall market sentiment. A little bit of hope as well, though, that we could see a so-called taco trade coming through. But Russell actually coming through saying that they've now got a new Mexican food acronym for what you could see from the US president. Tamales, standing for Trump always messes around, leaves everybody shafted. So we'll wait to see what happens. But getting to the themes of today, amidst, of course, all of the uncertainty, we do have these truce tremors, the US military launching strikes on Iran for a second straight day. The attacks coming just hours after President Trump said at the NATO summit in Turkey that the US would probably target Iran again. We are also looking at oil spiking, Brent crude rallying for a third day, climbing above $79 before pairing some of those gains as these latest strikes stoke fears that the conflict could disrupt shipping through the waterway. And new kid on the block, FTC consolidating, surging as much as 17% in its debut on the market. It is the largest IPO to hit the boards on the ASX so far. It is the construction of 2026, I should say. It is the construction and fit out business, FTC Consolidated. It raised $400 million in its IPO. It has a market cap of around $1 billion. And it overtook Skin Candy and Koala as the biggest float of the year. Now, we were actually lucky enough to be at the bell ringing, and we heard from the founders, the brothers that are behind the FTC business.
AFDC has a turnover approaching $2 billion, staff exceeding 700 people, and we operate out of 6 offices in separate states. It hasn't always been like that, and in the words of Paul Keating, we started during the recession we had to have. We had a staff of 12, no turnover, a dodgy office, and a boardroom table made out of a recycled door. When we started, we were driven by the fear of failure. This fear still exists today and ensures that we continue to display the same level-headed approach to business that we always have.
3, 2, 1.
So shares there up 13% on its debut at $3.39. I took a couple of snaps as well. They're not as good as cameraman Adrian Tan's vision that you just saw there, but let's bring them up of the bell ringing, just kind of showing you the overall momentum that we saw on the day. There you go. That was just as it was listing, and there was quite a few people in the room. And then we'll flip it around and have a look at the energy stocks. All right, energy shares up by 1.5% today as we saw those gains coming through in Brent crude. Having a look as well at what we saw in mining stocks amid this threatened strike action for BHP, sending it down another 0.9%. Rio Tinto off 3.4% today. Quick look at the tech stocks as well. Xero had a good session, as did NextDC. So we touched on FDC there, having a very solid debut. We'll have to get that fixed from auto to FDC Consolidated, but as I mentioned, it raised $400 million in its IPO. Fletcher Building also soaring today after upgrading its full year 26 earnings by about 6.4%. Steadfast slightly higher. It says takeover discussions with a consortium continue after the bidders reaffirmed their $7.7 billion takeover proposal. Also having a look at Northern Star, down about 1.4%. It appointed Perseus Mining Chief Executive Jeff Quartermain as independent non-executive director, and Catalyst Metals was also weaker, securing gold price protection through forward contracts. Telstra as well, coming back a little after that sell-off yesterday. CFO Michael Ackland denying the fault was caused by a cyber attack. Let's welcome to the COB George Barboris from K2 Asset Management. And George, never a dull day in these markets. I don't know if you heard me say that Russell's come up with tamales now, but it really just remains to see what US President Trump does next, I guess.
Yeah, good afternoon. Good to be with you. Yeah, so no shortage of acronyms, but at the end of the day, you need to understand strategy and put it in perspective. NATO meetings in Ankara, there's been a clear narrative and been able to get Europe to upgrade their defence spending as a percentage of GDP. A couple of nations out of the 27 EU, but NATO is obviously more broad-based. There's a couple of nations that are really not contributing to that. So he's been able to get that upgrade, that's worked, and he needs to reinforce that. So as opposed to how does he convince them to do that, that's easier said than done. And obviously that direct criticism he made straight to Spain, that obviously won't fulfil the commitment they made 6 months ago about upgrading their spending as a percentage of GDP, because they needed that signature with the other 26 EU members. So the thing I want to reinforce here is that that US president will go and do whatever the individual can to be able to get larger participation of NATO to acquire more defence spending. It's obviously got to be pragmatic, and at the other side of that, it's very convenient that the issuer and supplier for a lot of that defence spending is a US of A, so that liability of the 40 trillion debt. So you can sort of see what the individual's trying to do and just force that one through. So I'd say there's a lot of dealings around NATO in the meeting, now that it's finished the 2-day meeting, but that's I think that's got a lot to do with it as he's negotiating with these multiple NATO members.
And at the same time, earnings season continuing or starting in the US. So what do you see here in terms of, further momentum for US equities?
Yeah, so now I'm going to be subjective. I don't like being subjective. The pace of upgrades to EPS year to date has been so overwhelmingly positive. Cannot see that continuing. That's an easy statement to make. So we're seeing expanding EPS. But the thing to reinforce here in aggregate is that we are looking very quickly, and the 2 points I want to make are expanding EPS that are going to be contributing out to the other sectors, and energy and materials and financials and transport and utilities, and specifically healthcare in the US. We want to see them upgrades, but not the same degrees as the AI CapEx supercycle spend. But when we get 1 year forward, this is, as you're speaking to everyone, we're playing around with our numbers, we get a circa $395, $405 EPS basically for the S&P 500, and this is why the multiple hasn't really expanded, because the earnings have come through and delivered. So the multiple about the same. So around 20 times you get that 8,000 target of the S&P 500, and that's what we're playing with as we're writing our notes and reports, for year end. So 1 year forward, we see that the S&P 500 at 20 times with a very modest upgrade of the earnings. That's much slower than the first half of the year. We get that 8,000 target. However, volatility is the norm, and it'll be very volatile and non-linear in its way of getting there. But hopefully that makes a little bit of sense. So we are looking for the financials from next week. We're looking for US industrials and very much the healthcare. What is happening there with those earnings to be able to get to that 400 EPS target for the S&P 500, which gets us to that 8,000 target, which everyone's sort of looking towards in the future.
You say, though, be wary of EM equities. Why is that?
Predominantly, EM is, we're taking profit where we can, but up to 40% of it has been AI CapEx spend, Taiwan, Kospi, and a little bit of China. So the thing to reinforce there is that when people are investing in EM, they're not really thinking that they've gone into this super cycle on the AI infrastructure rollout and build. The thing to reinforce is that as many companies as possible from Korea and Taiwan will dual list in the US to attract more capital. But I think the EM being overweight the AI cycle is not what people are thinking, and I think the best has happened, and that's why trimming would be our recommendation.
Trimming in EM. All right, George.
In EM.
Yeah.
In EM.
Yeah,
yes.
Okay, let's have a look at what we're going to see in terms of some of the central bank action as well. So with the downturn in the housing market here, is that helping the RBA doing some of the heavy lifting, do you think?
Spot on. It's doing, I know this is a delicate topic, and I know it's very sensitive for depending who's listening to it, but from the Reserve Bank perspective and the government's perspective, house prices, if they were to, in a linear fashion, be 10% lower this year versus last year, will do a lot of the work for the RBA. And we don't have as much time now, but you need to get your housing economists and look at our value of housing stock relative to our debt burden, relative to our GDP versus other markets. So it would be nice and convenient if it was 10% lower, because that's not a bad and doubtful debt rollout for the banking sector. And if that was to be delivered or persist a few more months of weaker or low clearance rates and weaker house prices at the margin, that will mean that rate cuts will be on the agenda in the first half of next year, because a lot of that recalibration is occurring. Again, it's a delicate topic, but the government can't admit to that, but it is sort of solving that sort of. It's a correction that's the whole world doesn't understand why the valuations of property in Australia are where they are. So, but if there was a recovery and a surge of house prices next year, that just means that the rate cut cycle won't be as deep as people can expect to be, given that household consumer sentiment, my final point, is around that 50-year low. So we know households are doing it tough. You know, it's unforgiving out there. We know the OECD's already mentioned and downgraded Aussie GDP. We know real wages are behind. But if the house prices start rallying, which we'd expect, it's a shallow sort of correction next year, that means the rate cuts won't be as severe as people might anticipate going into year end.
And what about what we see from other central banks? Because there is a likelihood that we will see some more rate hikes by the end of the year.
Yeah, so like a lot of your guests, I've been saying, Juliet, that there's a synchronisation of central banks compared to where we were 3 months ago, and we expect additional rate hikes from the ECB. They're well behind the curve, Bank of England and the BOJ by year end. And then we're looking at the US. People are looking at higher rate rises for the Fed funds rate. We say that current settings, whether you're using 7.75 or 1% real Fed funds cash rate, it's still restrictive monetary policy. They've got expanding earnings, resilient US conditions that are coming through time and time again, holding up global GDP. It may warrant another rate rise, but we believe in the first half of next year. It's a wait and see approach. But we've got that new look FOMC. It's going to be recalibration, less guidance, removing the dot plots because it's just not worth talking about. It's irrelevant. And it's about communicating to the market that it's all about data dependency, which is more objective, which probably fits into what a lot of economists like doing.
George, always a pleasure. Thanks so much for joining us, George Barboris there from K2 Asset Management in Melbourne. Well, getting back to the stock of the day, it was Telstra. Nadine spoke with Mathan Somasundaram from Deep Data Analytics, Howard Coleman from Team Invest.
Telstra as a business was making enough per share 15, 20 years ago that it could pay a 30-something cents dividend every year. I think it was 32. It's now earning only 20 cents a share and paying less than that in dividends. So despite inflation over 20 years or 25 years, Telstra's income has shrunk even in nominal terms, let alone in real terms. So it's one of those that from any kind of value investor point of view, you look at it and you say, well, it's a company you definitely want to avoid.
Telstra looks pretty good. I don't see an issue in the short to medium term. I think the Starlink will have an effect, but that'll, as Howard said, it'll take time, and it's another competitor. I don't think it's suddenly going to change the dynamics dramatically. The thing about Telstra is it's a behemoth. It dominates the market share. Yes, it's having problems. What's their competitors like? They're even worse. So in context, I think it's a defensive yield, and all I know is everyone's carrying a phone.
Let's have a look at some of the leaders and laggards in today's session. Kicking it off with Fletcher Building, we touched on it having that upgrade to the market. New Hope, Megaport, Mesoblast and Infotrill also did well today. The laggards were Pantoro, Minerals 260, Magellan, Catalyst Metals and Amcor. A quick look at what we saw in the small end of town. These stocks on your screen did well, including Finder, which was up more than 23%. But heading the wrong way were these stocks, including LTR Pharma, which was down 7.4%. Tonight, not a lot out, but we do have US June existing home sales, and to George's point, second quarter earnings. So PepsiCo will come through with its numbers. And tomorrow, also very light on, but there is a public holiday in New Zealand, and Japan's June PPI data is released. So a flat finish on the CBO 200, the S&P ASX 200 down 22 points or a third of 1% to 8,762. Well, we'll see if there's a taco trade or a tamales trade or whatever the Mexican acronym comes through, and we'll be back from 9:45 a.m. Eastern tomorrow. See you then.